Thank you for joining us. Today we've had the great opportunity of having our asset consultant here from Drummond Capital Partners, Mark Fenech, who assists with constructing and the management of our ongoing pathway portfolios for Navigate clients. So we appreciate the opportunity of having Mark here today to help us provide some insight into the current economic climate, as well as to hopefully provide some optimism on the outlook moving forward. So thanks for joining us today, Mark.
My pleasure. Thank you for having me.
So the hot topic and question on a lot of our clients and broader client base is lips at the moment is the current geopolitical tensions with a particular focus on Iran and the Middle East. What do you see as potentially the ramifications in the short term over, say, the next 6 to 12 months, or key considerations for portfolios?
Yeah, look, I think certainly the first number of months looking forward seem to be a little bit more volatile than what we've recently experienced in markets. Look, in terms of our outlook on that, though, we're very forward looking and think about long-term outcomes for clients. Certainly, the risks are elevated at the moment. But that said, there are actually some positive elements going on within the economy at the moment. Company earnings are actually on the up, and we're expecting that to be in place for the next 12 months at average rates. And what that means is we're seeing some very considerable drivers, primary drivers behind that growth. We have the artificial intelligence theme playing out. We also have accommodative monetary and fiscal policy settings around the globe. So that will support earnings growth for companies ultimately. And when you have higher earnings growth over time, you have higher share prices as a result of that. So risk is certainly elevated at the moment, but we think that there are some longer term drivers in play that will ultimately benefit investors. So the next 12 months, yes, we actually are quite positive about where markets will lead. It's probably worth pointing out and saying to investors that we've come off a very strong run of returns over the last few years. So the returns may not be as high this year, but we still, given the factors I've just mentioned, we expect it to be on the up.
Great. Thank you, Mark. And Mark, to that end, many of our clients are asking about gold. What are the key drivers behind gold's current meteoric rise, and what's the outlook moving forward, particularly around commodities and gold specifically?
Sure. Yes. Look, gold has certainly had a quite a massive run in markets. It's up over around 70% over the last 12 months, so that's quite a lift. And it's primarily been on the base of being a safe haven asset. So that's been a primary driver. We've seen central bank diversification going into the asset class, but we've also seen household demand flocking into the stock. We've seen China have some interest there at the household level, but also if the Martin Place queues are anything to go by in Sydney, we're having some of that domestically. Now, look, as an asset class, it doesn't generate income, but it does tend to behave differently as an asset class to, say, equities and bonds, and that's why it's been seen as a hedging tool within portfolios. But that said, you have to exercise caution with using the asset for that particular reason. There are many different assets available in a well-constructed portfolio that can act in a defensive way and somewhat of a hedge. So gold shouldn't be relied upon by itself. We do have exposure in the portfolios with gold. We added a small cap manager last year that has exposure, and we've seen some uplift as a result of that. And we have some exposure more broadly too with our index allocations, both domestically and internationally. So yes, be wary of using gold in isolation is probably the key thing there, but it can be used as a hedging tool.
Currently, depending on where your source of truth or source of information comes from, there are conflicting views around the US economy. Should investors be comfortable with investing in the US, and more broadly, what's Drummond's view overall of the US?
Yeah, look, obviously there are some concerns with the levels of market concentration in the US, especially given that there's rising geopolitical risks in the world at the moment, trade policy uncertainty, and also from a valuation perspective. Equities in the US are higher than other regions. So if you think Europe, emerging markets, Japan, even Australia. So there is certainly a case for asking a question on the US in that regard. But that said, the US is a region that we've seen some rotation out of there in the last couple of months. So arguably some risk has been taken off the table. But that said, we've come out of an earnings reporting season over the last week or so where a lot of the companies reporting actually beat the earnings guidance that were given on those particular companies. In the order of around about 73% of the top 500 companies that have reported beat analyst expectations. So that's representative of a very strong corporate environment, and certainly that earnings growth is helping share prices. So I think when you consider that, and also the fact that you look at say the MSCI ACWI index, it's an unusual name we use in finance, but basically that consists of 2,500 companies around the globe, represented by 24 developed economies, 23 emerging market economies. America makes up about 63% of the weight of that particular index.
Yeah.
And that didn't happen by accident. That happens as a result of a country that is steered by innovation. It has a very friendly business regulatory regime, and we don't see that changing moving forward. And that's why we think that we're very supportive of continuing to hold position at the levels that we do have currently in the US.
No, terrific. Our clients can take a lot of comfort in that view and maintaining the long-term strategy moving forward. Appreciate that. What recent tactical allocations have Drummond made towards the portfolios more broadly, and what were the key drivers or reasons behind these changes?
Yeah, sure. Look, so over the last 12 months, I can talk to a couple of changes that we've made. We saw that following Trump's announcements around Liberation Day, that would create some issues around trade policy and a potential risk on the US currency. So we adjusted portfolios accordingly from a currency exposure, and that has helped portfolios over the last number of months as the currency came down. And we also saw that there was, on the back of the earnings growth broadening out in the marketplace, that it wouldn't just be the big tech companies that were recipients of that growth, that we saw that really branching out into other sectors and market caps within the marketplace. So we established a position in a small caps manager, and that also has benefited the portfolios very well. So I guess from both angles there, what we've done is, from our tactical asset allocation approach, is really manage the risk, but also captured opportunities on the upside that we foresaw.
And Mark, what would be one key consideration for investors, or if our clients could have a key takeaway from our discussion today over the next 12 months, if you could speak to those points?
Sure. Look, understandably, there's a lot to digest with what's going on in the markets at the moment. But we've spoken today to the positive side of things, and I guess also some of the risks. And I think with respect to the risks, I think one key takeaway is that right now we're in a situation where risks are somewhat elevated, but we don't get to the other side with risk. We don't get to a point where it doesn't exist anymore. Risk is a constant when it comes to markets. So I think what I'd encourage investors just to be mindful of is that it's risk is here to stay. And are you invested in a strategy that really thinks about risk and manages risk appropriately, so you can navigate throughout your investment journey to achieve your goals?
Appreciate your insight and time today, Mark. I know our clients highly value your input, particularly across the portfolios. So on behalf of Navigate Financial and our clients, we really appreciate your thoughts here today and your time.
My pleasure, Callan. Thank you for having me.